This is the story of Bruno Iksil, a quiet French trader working in a London office building that most people had never heard of, who somehow lost more money than the entire annual budget of the SEC 3 times over. And the craziest part, he tried to warn them and nobody listened. So, to understand how this happened, you need to understand what JPMorgan's chief investment office actually was. JPMorgan Chase in 2012 was the biggest bank in America. We're talking about a company sitting on hundreds of billions of dollars in excess deposits. Money that customers put in that the bank just hadn't lent out yet. It was just sitting there. And the job of the CIO, the chief investment office, was simple. Take that excess cash and invest it conservatively. Mostly treasury bonds, investment grade stuff, A-rated, safe, boring stuff. The investment equivalent of basically leaving money under a mattress, but slightly better. That was the whole mandate. Don't lose money, just sit on it responsibly. The woman running the CIO was named Ina Drew, one of the most powerful people in banking at the time. She'd been with JP Morgan for 30 years. She was well respected. She was trusted completely by CEO Jamie Dimon. And inside her unit, operating out of London, was a trading desk called the Synthetic Credit Portfolio. And it was run by a man named Bruno Iksil. Iksil was by all accounts brilliant, quiet, not flashy. He wasn't the type to show off. He just showed up and made money. And for years, that's exactly what he did. In 2009 alone, his desk generated over $1 billion for the bank. So naturally, people let him do his thing, which is exactly how this kind of disaster always starts. Okay, so I'm going to explain the trade in plain English because the financial media made this sound way more complicated than it actually is. Iksil's desk was trading something called credit default swaps, CDS. Think of them like insurance policies on corporate debt. If you own a bunch of bonds and you're worried the companies behind those bonds might default or go bankrupt, you can buy a CDS as a sort of protection. If they default, the CDS pays out. If they don't, you just paid the premium and got nothing. Iksil was doing the opposite side of that trade. He was selling the insurance, essentially betting that a basket of 121 major American corporations would not default, that credit markets would stay healthy or improve. The specific instrument he was using was called CDX IG9, a credit default swap index tracking those 121 investment-grade companies, boring, stable, blue-chip American businesses. On paper, this wasn't such a crazy bet. These were stable companies. But here's where it got problematic. The position got enormous. Not just large, not just significant. We're talking about trades so massive that Bruno Iksil, one trader at one desk in one London office, was moving the entire global derivatives market by himself. Now, here's the part nobody tells you properly. While all of this was happening, while Iksil's positions were growing to incomprehensible size, the risk management team was supposed to be monitoring the exposure. They were supposed to be calculating how much the bank could potentially lose, keeping track on whether things were getting out of hand. But they were doing this with an Excel spreadsheet. I want you to think about that for a second. One of the world's largest banks, hundreds of billions in assets, and the tool monitoring the risk of a massive derivatives portfolio is Excel. It's the same software your high school used to track basketball scores. Inside that spreadsheet, someone made a mistake that would go undetected for months. The formula that calculated the portfolio's risk, or its volatility, was supposed to divide by the average of 2 hazard rates. Instead, it divided by the sum of those 2 rates. One wrong operation, average versus sum. What that did was cut the calculated risk approximately in half. The model told Iksil and his managers that the portfolio was significantly less dangerous than it actually was. The red flags that should have been screaming weren't even lighting up. So from inside the bank's own risk system, everything looked manageable, under control, fine. It wasn't fine. Actually, it was the opposite of fine. And the error sat there, undetected, while the position just kept growing. By early 2012, hedge funds had figured out what was happening. A manager named Boaz Weinstein of Saba Capital Management noticed that the CDX IG9 index was unusually mispriced, and he figured out why. JP Morgan was cornering the market. Cornered markets always snap back. Weinstein told other investors, word spread fast, hedge funds started lining up to take the opposite side of Iksil's trade. They were essentially betting against JP Morgan, and they were right. Then, in April 2012, Bloomberg and the Wall Street Journal broke the story publicly. A single trader at JP Morgan was dominating the entire credit derivatives market. Jamie Dimon's response was immediate and spectacularly wrong. He went on live TV and called it directly a tempest in a teapot. That quote will follow him for the rest of his career because internally, at the exact moment he said that, things were already catastrophically bad. And it was just about to get worse. Because management didn't just fail to fix it, they actually tried to hide it. Phone calls were recorded, instant messages were saved, and what they revealed was damning. Iksil's supervisors, specifically his direct boss, Javier Martin Artajo, and a junior trader named Julian Grout, were pressuring the team to mismark the positions, to record the losses as smaller than they actually were. There was literally a shadow spreadsheet, a second separate document that contained the actual projected losses hidden from senior management and regulators. The bank's own risk limits had been breached multiple times. When that happened, the normal response is to reduce the position. Stop trading, pull back. Instead, management raised the limits. The VAR, or value at risk, the single most important daily metric at a bank, was flashing red. So they raised the VAR limit to accommodate the position instead of reducing the position to comply with the limit. That's like your car's oil warning light coming on and responding by covering the dashboard with tape. And crucially, Iksil himself later said he had warned them, repeatedly, that the trades were too big, that the risk was unmanageable, that they needed to unwind. Though his managers told him to keep going. On May 10th, 2012, JP Morgan held an emergency conference call. Jamie Dimon disclosed $2 billion in trading losses. He described the strategy, and I'm using his exact words here, as flawed, complex, poorly reviewed, poorly executed, and poorly monitored. A pretty significant evolution from tempest in a teapot. But $2 billion was just the opening number. Because the positions were still open, the hedge funds were still pressing, and the losses kept mounting. By July, the total was updated to $5.8 billion. By December, when everything was finally settled, $6.2 billion. Some projections at the worst point suggested it could have hit $9 billion if markets had moved differently. The consequences came fast. Ina Drew, the chief investment officer with 30 years at the bank, resigned. Several other executives departed. Martin Artajo and Grout were criminally indicted in the US for their role in concealing the losses. Neither has come to the US to face charges. Iksil, who cooperated with authorities, was never charged. JP Morgan paid $920 million in fines across US and UK regulators, including admitting to violations of securities laws, which is very rare for a bank of this size. Jamie Dimon's pay was cut in half, from $23 million to $11.5 million. The Federal Reserve's own Inspector General issued a report saying regulators had botched their oversight of the JP Morgan unit where this all happened. And here's the detail that tells you everything you need to know about how powerful these banks actually are. Despite losing $6.2 billion, JP Morgan Chase still posted a record profit of $21.3 billion in 2012. They lost more money than most countries spent on defense in a year and still had their best year ever. Bruno Iksil is still out there. He gave one interview after years of silence and said one thing that I think about a lot. He said, "I was singled out by the media. The trades were not the actions of one person acting in an unauthorized manner. My role was to execute a strategy that had been initiated, approved, mandated, and monitored by senior management." Was he a rogue trader who blew up the bank? Or was he a guy following orders who became the convenient scapegoat when everything went wrong? The answer, truthfully, is probably somewhere in between. It always is. Every week, a new disaster, a new set of warning signs everybody missed, and a framework you can actually use to spot the next one. So, subscribe if that sounds like something you want. Drop in the comments. Do you think Bruno Iksil was the villain here or the scapegoat? I'll be reading everything. See you in the next one.